Welcome back to the podcast. Don't forget to go to the website at retireyoungaudio.com and leave us a comment. Also, subscribe to the Retire Young podcast at Apple Podcasts, iHeartRadio, and Spotify. If you're just tuning in, Al was shedding some light on these financial markets and really how they work, how institutions trade and invest. And it's really based on something simple. It's based on supply and demand. When there's more buyers than sellers, price has to go up. When there's more sellers than buyers, price has to go down. And that's how the financial works. It's kind of like an auctioneer we talked about. And we want to get into in this segment, Al, I mean, if somebody is looking to participate in these financial markets, what do you think are some key things that they should know before they get into the markets?
Well, I think it really boils down to the word opportunity. And there's two things I think are really important. If somebody wants to participate in these markets, there's two things that are important. Number one, what the opportunities are. And number two, how to become prepared to have the possibility of benefiting from these opportunities. I'm going to quote, I think it was Henry Ford that said this. If not, I apologize, Henry. He said that success is when preparation meets opportunity. So those are the two things. What are the opportunities? And then how do you become prepared? And under the what part, that's knowing that there are market assets that will go up in value when the market goes up. And there are assets and strategies that will make money or that will give you the opportunity to make money when the market goes down.
Al, that doesn't make a lot of sense to most people, though.
Well, it doesn't. And the reason is that most people are just kind of counseled on making money in an up market. Really, the emphasis really is on buying in a bull market and then just kind of ignoring a bear market or correction. Well, bear markets and corrections are part of that world, the financial world, and to really be in a position where you can benefit, regardless of which direction the market's going, you need to know the strategies that are available to trade in any market condition.
So just to confirm there, when there's a bull market, that means price going up.
Sure, that's when the price is going up.
Yep, and a bear market is when price is going down. Just because a lot of investors have heard of that, but maybe just don't know what that means.
Sure, I think everybody kind of understands a bull market, and they look at that as being a great thing or a good thing. But a bear market, just that word, people take that as a negative. A bear market typically is when the value of the market goes down 20% or more. A correction, a simple correction, is a market drawdown of about 10% or more. But a bear market is not a bad market. It's just a way of making money in a different market condition.
It's just another opportunity.
It's giving you the opportunity in a different direction. And so let's talk about the different directions. If the market is going up, what are some of the strategies you can use? People invest in stock. People invest in the mutual fund markets, exchange-traded funds. And that's basically the same thing or similar to a mutual fund. It's a basket of an underlying that mimics or tries to replicate the return of a certain index or sector.
So what do you mean by underlying? What does that mean?
That could be, let's say that you are interested in the S&P 500. That would be an underlying asset for an ETF that mimics or tries to replicate the movement of the S&P 500. There's probably maybe thousands of ETFs. There are some that represent the technology market, some the financial market, some healthcare, pharmaceuticals, biotechs. I mentioned financials. You name it. There is an ETF that actually is geared towards that particular asset.
So let me ask you this, and because a lot of investors are in mutual funds, which only profit in up markets, what about ETFs? Is there other opportunities?
Exactly. Yeah, a typical ETF, if you have an ETF that mimics the S&P 500, that ETF is going to go up in value as the S&P 500 goes up in value. But there are what we call inverse ETFs, which go the opposite direction. So if the S&P 500 is down, that ETF should be up close to a similar amount in the opposite direction. So you can participate in down markets with ETFs. People can actually trade these in their investment or in their retirement accounts. You can't short the market, which is another way of participating in a down market. That's basically where you are borrowing a security and then you're selling it in the open market, planning to buy it back for less money later. Because you borrowed it, you have to return it. You can't do that in a retirement account, but you can use these inverse ETFs. So you have a way of participating in a very similar way to how the institutions are shorting the market.
And that's what it's all about, is you want to trade like those institutions. Investors, should be doing that.
Well, if the institutions are successful on a consistent basis, regardless of which direction the market is going, it just makes sense to try to follow what they're doing. And it's not just that they know the right assets to use in the different market conditions. A big part of their success and a big part of any investor's success should be risk management. Because that's a part of any trade, any investment. Even if you are in mutual funds, some people feel comfortable because they're it's a professionally managed asset, and you have diversification there. You have risk also. So the key is to be able to manage risk, and that should be a key part of any education that an investor is participating in.
And that's similar to anything we do in life. I mean, what's the first thing we do when we get in our car? We manage our risk by putting our seatbelt on.
Well, exactly, yeah, and you honor stoplights. If a stoplight is red, more than likely a person is going to stop at that point, and that's just managing risk.
Is that what we're supposed to do?
Yeah, I should write that down for you.
Write that
is
down
go,
for me.
Red is stop, Josh. Even when you're crossing the street, there's risk of getting hit, so you don't just blindly walk out into an intersection. You look both directions. If there's a walk sign there, a walk or don't walk, you honor that.
Let me ask you this,
that's managing risk.
Yeah, and let me ask you this, Al. Why do most investors not manage their risk? They just buy and hope.
Well, for one reason, they don't know how to manage risk, and they are told not to pay attention to down markets.
Yep.
That's part of that buy and hold strategy. The way it has to work this way if you're going to be a buy and hold trader or investor. You have to hold on through downturns. You have to hold on through bear markets, and just hope that in the end you end up with a profit, with a positive in your portfolio.
But that doesn't make a whole lot of sense, because the markets go down and they go sideways for a period of years. I mean, if people were investing in 2000 and 2008, they lost time. That's the big thing.
That's the key. It's the time you lose. The market will and always has come back, and probably always will, but it's the time it takes to get back. So if somebody lost, let's say somebody lost 50% during the drawdown in 2008, end of 2007 through the beginning of 2009, the S&P 500 was down 50%. That means you have to have a 100% return in a portfolio in order to just get back to where you were before. That can take many, many years for that to happen. And, unfortunately, the older we get, the fewer periods of time we have like that just to get back to where we were at one point in time before.
You're right. And time is that one thing that you cannot get back. And a lot of investors, Al, investors either have to get in the market at the very low when they first start working and get out at the very high. And how likely is that for someone to do that? It's luck.
Sure. And think about it. If you had retired in January or February of this year and retired at that point in time, you might have, within a few weeks or a month, seen your portfolios go down 30, 40%.
Yeah, that's important to understand that, and understand that institutions are trading different than the average investor. Al, we've talked about the stock market and ETFs, which is essentially the same type of concept. Now, we have other markets that I wanted to get into real quick here. Let's talk about the futures market and the Forex market, because institutions aren't just trading stock. They're trading stock. They're trading options. We'll get into that in the third segment, but they're trading futures and Forex, which is fixed assets, right? Now, yep. With that, why are the institutions, how can the institutions utilize different amounts of capital to do that?
Well, one of the reasons that they use futures and Forex is that you maximize the buying power of your dollars. So in futures, for example, that is a strategy where you are looking at something in the future, the value of something in the future. Airlines use futures contracts. Farmers use futures contracts. Companies like Cargill, General Mills, grain companies, they do the same thing. They have to know what the cost of their basic product is going to be, or in the case of airlines, what fuel is going to be.
They're hedging their fuel.
Sure, they're hedging their fuel so they can do their budgeting properly. And unfortunately for the investors, we can, as speculators, we can participate in that market too. And the great thing about futures is that they trade basically 24 hours a day. but you have many choices. It's not just the major stock markets, which are part of the futures world, but you're looking at commodities, sugar, corn, soybeans, oil, gold, silver,
Well,
currencies.
You even mentioned the stock markets. The S&P 500 has a contract.
Absolutely,
the Dow has a contract.
the
NASDAQ.
Right. So you have the opportunity to participate in things that are not all correlated to each other, and that's one of the great advantages of the futures market. Unlike stocks and mutual funds, when the market is in a a full bull market or bear market, the correlation between stocks becomes very close. So if something happens, if we do go through a correction or bear market, about 90% of the stocks are going to go down in value. With futures, you can have your assets distributed in a way that they're not correlated to each other. It's probably the only true non-correlated market that there is.
Well, when institutions are trading these, that's pretty much a given.
Correct.
Now, why don't they put the average investor in the futures and forex?
Well, futures and forex are short-term trading vehicles, especially futures. If you're looking for daily income or weekly income, it's probably the investment of choice, the asset of choice, because they're very short-term trading vehicles. A financial advisor, broker that maybe has 200 or 300 clients, you don't have enough time, or they don't have enough time during the day to be dealing with those short-term trades for their clients. It's much easier for them to put a person into a buy and hold strategy where you put together a portfolio, or they help you put together a portfolio and then tell you just to hold on to it, which is a great business model for them because there's not much work that goes into it, but they still collect their fees. I mentioned before, some of the things, the strategies people can use in an up market. I mentioned stock, mutual fund, ETFs. Well, futures and forex and options are also strategies that you can use in an up market.
So investors can short those markets.
Well, in an up market, they buy them, they go long. But in a down market, you can also use futures, forex, and options. And you can do basically the same thing as shorting. But with futures and in forex, you're not shorting. You're not borrowing anything. You're just selling a contract.
Okay.
There are options that will go up in value or have the potential to go up in value when the market goes down or up, different options. And then options can also be used in a range-bound market where you can have a position. It doesn't make any difference if the market's going up or down as long as it stays within that range.
Yeah, I'm glad you brought up options again, because in the next segment, I want to get into more on options. It's the puts and the calls, and that's what everybody says when they talk about options. They say puts and calls. I want you to describe those in the next segment. But it's really important, Al, to understand those other asset classes. Everybody knows the stock market. Having opportunities as investors to invest in other asset classes, the institutions are hedging their products, right? Well, investors can do the same thing. It's just they need to learn how to do that.
Sure, that's all part of that risk management we're talking about.
It is, yeah. So institutions trade different than the average investor, and that's a given. We know that's what's happening. So, Al, we have a lot more to discuss. We haven't got into the 401k or the IRA. I mentioned I want you to dissect options with the puts and the calls again. But I want to get into a little bit more on ETFs and what institutions are really doing with their retirement accounts. Thanks for listening, and don't forget to go to the website at retireyoungaudio.com and drop us a line.